Congrats on the new show, and looking forward to this.
Thanks so much. And I'm so glad to catch up with you and talk about the kind of environment we're in because it seems like there's a lot of cross currents, right? The Dow's up today, Nasdaq taking a hit, Treasury yields have really been the story. They're higher again, and it looks like there's been a swing in. I don't know if it's a swing in sentiment. You'll tell me that, but certainly in terms of focus, investors have gone from chasing those tech stocks again to being a lot more worried about inflation and what that might mean for interest rates. So, give me a kind of broad overview of how you're thinking about the situation right now.
Yeah, that's a great question, or and great way to start the conversation. We can drill down from here. I would say 2025 is a year in which the distribution of probable economic outcomes is both wide and widening. And the reason this is important is because we are in a very asymmetric point in the positioning cycle. Investors are sort of on one side of the boat, the very bullish side of the boat right now, when you study some of the longer term metrics that we track in our positioning model, which suggests that if we have a significant amount of uncertainty develop from an economic and policy perspective, we may actually see a trending kind of volatile, choppy market, and potentially even a crash if some of the more left tail risk type economic scenarios develop. And we do believe some of them will develop. Now, if they all develop, then we probably will crash. But we certainly believe at least some of them will develop, which we can unpack.
That's so interesting, and I think that's what people are sensing, and with the new year, everyone's like, "Hang on a second, we've gone so far," and they are really concerned about losing a lot of that, which I think is fair given what's happened over the last couple of years, and bonds always sort of seem to be that getting that bond call right and the economy call right, has been really important, and so many people have kind of got sucked into the lower rates, we're heading into recession, and only to have to walk that back again.
Mhm.
So what are we looking at in terms of part of the nervousness this week is we have CPI and PPI on tap.
Yeah.
What are you expecting? Do we have an inflation problem?
Yeah, I think we do. And we've been consistent about that for several years now. In fact, when you go, you look at our fundamental research summary. These are our current active themes, and they're organized in chronological order when we introduce them to our clients. And as you can see, the first theme is sticky inflation, which we authored in January of 2022. Essentially, the theme is arguing that the equilibrium inflation rate in the U.S. economy is higher, and moreover, we're not going to get back to 2% or even the Fed's 2.5% target on a durable basis in the absence of a recession. So that's kind of one of those bearish themes that now that we are kind of nearing the bottom of the inflation cycle and we're starting to meander higher, in our opinion, this theme will have more market impact over medium term time horizon. Also contributory to the rise in interest rates and the backing up of term premium, et cetera, in the bond market is the fact that our resilient U.S. economy theme, which you and I have talked about for years now, continues to be true, continues to be supported by the data. Obviously, most recently the December jobs report last Friday, and then another theme that is sort of contributing to this hawkish repricing of the Treasury market and by extension global interest rate markets is the fact that we're losing conviction on our J1 to soft landing theme. You recall that we've been arguing that the Fed has this asymmetrically dovish reaction function since the beginning of November of 2023, and starting in December 18th of 2024, we no longer see the Fed as having an asymmetrically dovish reaction function. It still has a modestly dovish reaction function, but it is moving in the wrong direction from the perspective of pricing out rate cuts from the forward rate curve. And then finally, the last theme, which we introduced in November of last year, really is a kind of an ode to what we talked about at the onset of this presentation, which is the distribution of economic outcomes is wide and widening. And the reason for that wide and widening distribution is because we're going to have a series of dramatic changes to fiscal and regulatory policy. We're going to see things like tariffs and securing the border potentially contribute negative supply shocks to the economy, whereas we have things like tax cuts, deregulation, and accelerated energy production produce positive shocks in the economy. And really, the size, sequence, and scope of those shocks really has a significant potentially have a significantly negative influence on asset markets if we get a lot of the bad stuff before we get a lot of the good stuff. And one final thing I'll say on the bad stuff is we also are likely to see a hawkish shift in Treasury net financing policy this year. If you go back and you study Scott Bessent's commentary around Janet Yellen's decision to her preference for bill financing in the Treasury market, it's very likely that he shifts us from overly allocated towards bills to issuing a lot more coupons and on a relative and nominal basis than Jenny Yellen had. So that's also a potentially negative dynamic as well. So when you put those things together, Maggie, sticky inflation, an economy that's still doing just fine, a Fed that's getting less dovish and potentially even neutral at the margins, and then a sequence of fiscal and regulatory policy changes that could come in a sequence that is negative for the economy and asset markets. This, in my opinion, is why we're seeing such negative price action in the bond market, the widening of term premium, and how that's facilitating to lower valuations in the equity and credit markets.
Yeah, which all makes a lot of sense. Let's unpack a few of those, and let's start with the inflation since we're going to get these readings today.
Yep.
Because there is some disagreement on this. There are some people who feel like maybe we're going to get a surprise, even though that fear is rising. That ultimately it's not going to be a very large spike, and maybe the fears are overblown. But so what's driving inflation higher at this point, and where's it showing up? We know before a lot of it was supply chain and demand, right? We had high demand from everyone having this money chasing goods. Where's it coming from now? I would have thought that some of that would have worked its way through the system. So are there new reasons, or did it just never really go away? Are we just settling at a higher level?
Yeah, it's a great question. So I would say, with respect to inflation, there are three things that give us confidence that inflation is bottoming and is likely to meander higher over the medium term. I would say so. Number one, when you go back and you study the U.S. business cycle from the perspective of the various cycles that contribute to the business cycle, what we find is that inflation is the most lagging indication of the business cycle. It typically breaks down durably below trend 12 to 15 months after recession. And again, this analysis stacks each of the 12 post-war US business cycles on top of each other to sort of see how they behave late in the business cycle, into and through a recession. You can see it even clearer on this chart where we show headline and core inflation. And so, with this being the history of, kind of the entire post-war history of the U.S. economy, us as investors, we should not be expecting a durable breakdown in inflation in the absence of a recession. And if you look at our models, recession, it continues to be a low probability over a medium term time horizon. So what that ultimately means is we're probably going to hit the bottom of the inflation sine curve and start to cycle higher, much like we always do. Inflation is a cyclical process. And so, once we get to a low enough level, we're going to start to rise again from there, just from a purely statistical perspective, which is what this model is designed to forecast. And so, we have inflation kind of meandering higher in the first half of the year with a meaningful acceleration kind of in the middle of the year, before kind of settling out at a higher level in the second half of the year. But this first kind of 6, 7 months of the year, when we're getting better than expected or higher than expected inflation data, could potentially contribute to some volatility in asset markets. And then finally, with respect to this inflation process, we are seeing leading indicators of inflation that are giving us confidence in this kind of hawkish view. If you look at core PPI, which started breaking down, let's call it a year and a half ahead of the core CPI and core PC deflator time series, because those time series had those lagged, kind of housing elements in them. This time series, the leading indicator bottomed about a year ago, and it's been trending higher over the past year. And it's sort of it's sort of supportive that we may actually see a bottom on core CPI and core PCE that is kind of inconsistent with this 2% target that the Fed has outlined, continues to commit to. And so, in our opinion, this is really being driven by a potential confluence of a reacceleration in wage growth, which is a very high probability if we close the border and we see a significant reduction in labor supply growth. And we're probably going to see a significant acceleration in unit labor cost inflation right now as well. Unit labor cost inflation over the past 6 months is actually annualizing at minus 0.1%. That's historically anomalous. In fact, the long run mean of unit labor cost inflation is somewhere around 2%. And so if we just go back up to 2%, that's going to create a tremendous amount of pressure for U.S. corporations to pass on that acceleration in unit labor cost inflation to consumers in the form of faster CPI, faster core PC inflation, if we do not see an acceleration in productivity growth to offset that. And the issue with expecting that is productivity growth is already currently compounding at an above trend level. So maybe we get productivity growth to accelerate from here, but it's very unlikely. So what is likely to happen, based on everything we just said, is unit labor cost inflation accelerates. Corporations push that through in the form of higher, faster price hikes, and we get kind of inflation meandering higher from here.
Yeah, and it's really great that you point that out, because that is the difference in some of the people who are looking at inflation differently, is they think that we are in this sort of, productivity boom because of AI. every people disagree on the timing, but sort of Ed Yardeni, for example, he thinks that the sort of magical pixie dust of productivity is interesting right now and maybe will surprise on the upside. So that is the very interesting aspect to pay attention with inflation. We have so many good questions coming in the chat. Hi, everybody.
Hey,
That
what's up,
really
guys?
they're really on it today, Darius. I'm gonna get to a few of them, but I just want to go back and talk about that last point you made because I think this is so important, and I love the way you're looking at this, and it really relates to the Trump administration coming in. When you say there are these potential changes happening, or at least a lot of them could be pegged maybe to some action we may or may not see in the Trump administration. Um, Explain to us a little bit this sequence. The way I read it, and you can tell me if I'm wrong. I think you said triple S's, the triple
Yeah.
S's, which I loved.
Oh,
But
yeah.
it's like when you talk to people, and of course bias, political bias enters into this, but you'll talk to one person and they'll be like, wow, this is going to be so good for business, so good for the economy, so many of these changes are so needed. And then you have other people who are really concerned about some of it. I mean, some, it's obvious, deregulation good for business, but they're worried about immigration and deportations
Tariffs.
and the effect on wages. They're worried about tariffs and what that could do. So you tend to get everyone kind of locking in their camps as to what's going to happen. But your take is seems to me to take out the bias and is really about it's the order of events that happen, right? And like what happens first, and is the economy ready for that? Just put a little color on that for me because I think this is incredibly important.
Oh, I appreciate you asking the question and characterizing that way. I fancy myself to be a data-driven centrist, both from a political standpoint, but also from the perspective of being a trusted macro risk manager for our thousands of clients. And so, they expect me to analyze these markets and the economy and all these political dynamics in an unbiased manner. And that's something that I've committed to and will always commit to. And so, when I think about these things, to me it's pretty simple. We just have to listen to President Trump and the various leaders within the public Republican Party and take their word for it. They want tax cuts, they want significant deregulation. They're going to have to, because they're going to use the reconciliation process to implement, to extend and expand the Trump tax cuts. They're going to have to find either revenue or expenditure reduction and revenue raising offsets on any sort of deficit increasing tax cuts that we're going to get relative to the current law baseline. And we know that we're going to have a deficit expansion relative to the current law baseline because the current law is calling for the Trump tax cuts to end on December 31st of this year. So any change to that obviously represents a positive shock to the deficit. And so they're going to have to offset that based on the Byrd rule accounting procedures in the Senate, in the Senate reconciliation process. And so what that ultimately means is we're going to see significant expenditure cuts via Doge, the Department of Government Efficiency. Elon Musk was out last Friday confirming our thesis that we are probably not going to see significant expenditure reduction just based on some of the categories that are kind of being ring fenced from the process. And so, we'll take a victory lap on that, but they're still going to cut hundreds of billions of dollars away out of the, out of public sector expenditure. So that's one dynamic. Another dynamic is they're going to have to use tariffs as a revenue generating offset feature in this reconciliation process. So we know those are coming as well. And then finally, this whole pivoted net financing policy that no one's talking about now, but that they will be talking about perhaps as soon as the end of this month when we get the quarterly refunding announcement. I mean, I believe Scott Bessett, who I've known for a long time, is a former client. He will, I think this extended confirmation hearing is this week, and so he might be in the seat in time for the Q1 quarterly refunding announcement. And he may decide to use that announcement to send the signal that, okay, there's a new sheriff in town. My goal was not to juice financial markets in the economy like Janet Yellen very clearly decided to do with their preference for bill financing and start to shift, the Treasury net financing policy to coupons. And the reason this is important, Maggie, more so than normal. Obviously, quarterly refunding and net financing policy by the U.S. Treasury is significantly very important. It had a significant influence over draining the $2.5 trillion that was in the reverse repo facility out of the reverse repo facility and into asset markets. This stuff is always matters, but the reason, in my opinion, I think it really matters more than normal in 2025 is because 2025 represents one of the largest years ever in terms of the growth rate of refinancing. The refinancing demand for the kind of the global private sector and global private and public sector is as great as we've ever seen it. And so, any sort of change in net financing policy that pushes more coupons and more duration risk onto the market at a time where there's a significant refinancing need of from lagged borrowings of yesteryear. That to me could potentially create significant consternation and volatility in asset markets. So going back to your question with respect to the size, sequence, and scope, we're going to get a lot of good stuff. We're going to get a lot of bad stuff. It's about the order in which we get the good stuff versus the order in which we get the bad stuff. And if we get good stuff first and bad stuff after that, then you could probably see markets do well and then trade off and sell off to correct and account for the bad stuff. Or vice versa, we get a lot of the bad stuff first and then followed by the good stuff. You could potentially see markets do quite poorly until we start to see the whites of the eyes on tax cuts and deregulation, things of that nature. So this year is going to be very difficult and very tricky for investors to risk manage. And I highly recommend folks are, partnering with firms like ours or, it's someone else. You don't have to be partner for it to macro, but I highly recommend that you have some proven quantitative risk management systems to help guide your portfolio in a year like this, because it's not going to be as easy as it was last year.
Yeah, it feels like that and complex, right? These are some of these issues are really complex for some ordinary folks who this is not their full time job. And how you just described it to me sounds like a baton pass, right? If any of you have ever run relays or have anyone in your families run relays, like a baton, you want one passing off seamlessly to the next. And if
Right.
it could happen, that would be great. But Washington and the odds of that are very, very difficult. And without any sight into the future, hard to quantify those risks and what's even able to get passed. That's the other thing. We're going to hear a load of proposals, but what can actually pass
Yeah.
is going to be really tricky. I think that's such a great framework, Darius. I really like that. I want to ask Melson's question because I think it's related to this, and you may have already partially answered it. Maggie, can you please ask Darius how he sees the wealth effect channel impacting inflation interest rates, given that the RRP is almost fully drained and the TGA is down to its last $700 billion?
Yeah, we've studied the U.S. business cycles extensively, as certainly anyone I've seen on the sell side do. And what we found is that things like the wealth effect, so for instance, net worth, household net worth, corporate net worth, big time lagging indicators. They don't really lead to anything. They're just as lagging of an indicator as inflation. And so, if you're trying to front run the inflation cycle, you're going to want to have more informed views on things like growth, things like liquidity, those corporate profit dynamics. Corporate profitability has an influence over that on a longer term time lead as well. So, in our opinion, I don't know if this is the appropriate thing to be focused on with respect to the inflation cycle. If you want to get the inflation cycle right, you got to study the drivers of inflation. It's commodity prices, it's the unit labor cost inflation and the relationship between that and productivity. It's housing prices and the housing market dynamics as well, which continue to be pretty tight. So, in our opinion, again, we're not calling for inflation to have this significant acceleration back towards 9% like what we saw in 2022. We're just saying it's probably closer to the bottom of its sine curve and will meander higher over the medium term. And that is moving in the wrong direction relative to both consensus projections and the Fed's projections. And if we're right, if 42 macro is right on inflation, we will have problems in asset markets, because ultimately it means the Federal Reserve's monetary reaction function the Fed will just get put in a box. The strike price for the S&P put will go lower. The Fed will get put in a box. They won't be able to do anything to, contribute to what is a very significant demand for global liquidity in 2025, going back to that refinancing cycle analysis that we performed. Again, this is 2025 represents one of the largest years ever in global refinancing demand. And contributing to that is about $11.5 trillion of gross Treasury issuance that we're going to hit, which is by far an all-time high when you study the marketable Treasury debt that's maturing, when you study the annualized fiscal year-to-date budget deficit and the annualized rate of divestment from the Fed's portfolio. There's a lot of Treasury supply hitting the tape in a year where we could have a hawkish shift in net financing policy, in a year we could have a hawkish shift in monetary policy, in a year where we could have tariffs driving up the US dollar and driving down everyone else's currencies. And all those things are really negative from the perspective of asset markets in the context of where I think we are in the positioning cycle, which is asymmetrically bullish. We have an extreme bullish positioning right now that, again, if any one of these negative things happen, you could have a significant correction in asset markets. If a bunch of them happen, you're probably going to have a crash.
So, and what does it mean for bonds? Constantine asked, if you're going to say interest rates up or down, can you please ask Darius to take a stance on short versus long? Um,
You mean,
I'm not sure.
do I
Do you mean
expect interest rates to go
Constantine put
higher
another
from here?
comment. I don't know if you mean the time frame or if you mean duration, like in terms of the short end versus the long end. So if you want to clarify that question, that would
I'll
be
just
great.
answer both. I'll
Yeah.
answer both. Definitely want to be concentrated on the short end of the Treasury curve. Anytime you're talking about inflation accelerating, you're going to want less duration risk than more duration risk. And you're probably talking about an environment where interest rates continue to head higher from here. Now, again, the economy is going to slow, very likely to slow. The labor market is likely to moderate, but it may not slow fast enough, and the labor market may not moderate fast enough to offset what is probably going to be a pretty market acceleration in wage inflation and unit labor cost inflation, just as a function of shutting down the border. Again, we added eight and a half, almost 9 million bodies to the U.S. labor market during Biden's presidency, largely as a function of this sort of open door policy with respect to our southern border, and that contributed to massive decelerations in wages. The
Mm.
employment cost index decelerated, basically got cut in half to right around 2.9% on a quarter over quarter annualized basis over the past couple of years. Now, are we going to stay there if labor supply growth really starts to materially move in the wrong direction? Probably not. It's probably we're going to wind up in an economy that continues to expand and continues to tax the available resources that we have. And as long as we're taxing the available resources that we have, we're going to wind up with a much tighter labor market at some point in 2025 where we see faster rates of wage inflation. And if we don't see that a productivity growth offset that, then we will have faster rates of inflation because corporations aren't stupid. They're not going to sit around and just eat this. They're going to push it through to consumers.
Yeah, and we already saw, like, low unemployment sounds great, and higher wages sound great, but not if you have accompanying high inflation. Then everybody's
No,
really unhappy and really in pain, and that's what we
totally.
saw transpire. No one knows thyself asks, please ask Darius if the bond market sell off is the bond market's realization that bonds aren't investable during a fourth turning. That's a fourth
Partially.
turning for those who are listening is a reference to a very popular book that that's been making the rounds for the last few years.
Yeah.
Go ahead, Darius.
Yeah, no, totally. I would expand on that and say that the fourth turning is a regime, a secular regime of great institutional and geopolitical change. That's sort of the key takeaway, that's the underlying takeaway, and it's being driven
Mhm.
by demographic factors. So I would highly recommend reading that book because I believe very strongly that we are in a fourth turning, as my former colleague, one of my mentors, Neil Howe, would argue. And as a function of that, we're likely to see. We did a big deep dive study on what you should expect as an investor in a fourth turning from the perspective of the economy, monetary and fiscal policy, and ultimately asset markets. And one of the key takeaways from that deep dive study is we're probably going to see higher levels of inflation than higher equilibrium level of inflation than we used to. And the problem with that is the bond market is woefully and inadequately priced for higher levels of inflation. And the bond market is, I would argue, is woefully and inadequately priced for what another thing that we typically see in fourth turnings, which is a significant acceleration in the public sector balance sheet. We've already seen a significant acceleration in the public sector balance sheet, and in our opinion, when you kind of do the net of what's likely to come down the pike from a fiscal policy perspective in 2025, it's going to wind up with a acceleration in the public sector balance sheet relative to the current baseline of law. And so, what I'm looking at, what you guys are looking at in this chart here, in the top panel, we show term premium on the 10-year. So currently at 63 basis points. And for those who may be unfamiliar with bond market math, term premium is the excess yield you get as an investor for locking your money up for, in this particular instance, 10 years, as opposed to rolling over, bills, all the way through 10 years. Like, what would you, if you just compounded the bill return for 10 years, what would you get in excess of that for locking away your money? And as you can see, for a really long period of time, kind of throughout, most of this post-crisis era, post-GFC crisis era, we had negative term premium, which doesn't make any sense. You should be getting paid to pay liquidity risk in your portfolio, not paying the bond market. And so right now, the Treasury market is normalizing in term premium terms back to a, in our opinion, more normal level of term premium, which I would argue in a fourth turning, we should be beyond a normal level of term premium, just given the heightened uncertainty associated with the higher levels of inflation, which contribute to higher levels of inflation volatility and ultimately makes it a lot harder to price these securities. And so if you look at our math, we built a model that helps investors sort of contextualize where the bond market would be if we had a normal level of term premium. So we just subtract the deviation from the long run mean of term premium from the 10-year, and we wind up with a rate of 5.64%. So in our opinion, the 10-year Treasury yield is richly valued, and the bond yields are too low up until the point where they get to 5.64%, which with relative to the long run mean of term premium represents an appropriate level of term premium in the bond market. Now it may overshoot that at some point later in this fourth turning, particularly as we are in the phase where you're probably having a big mobilization of public sector resources, a big inflationary mobilization of public sector resources to deal with some, fourth turning style existential crisis. But I don't think we're there yet. But I am concerned that the bond market is waking up to the dynamics that we've been talking about since the summer of we've been talking about this stuff since the summer of 2023, by the way. So for those who may be waking up to it now in their portfolios, I wouldn't say shame on you, but you certainly could have tuned in before that.
Yeah, I mean, it is so hard. So, this is can this is such a simplistic question, but I mean, I think this is like the underlying fear that everybody has. Can the system handle rates at 5.6%? Because you had a lot of people say, listen, that was normal, right? We were at, when my parents bought a house, it was 13% or 7%. We used to live in a world where you had interest rates and in a world where you had some inflation. And if it's moderate and the pace of change, you have time to adjust for, we're kind of just really going back to the normal, right? Deflation and negative rates were a bizarro, reaction to the great financial crisis. But the system's different. There are all these passive flows. Everybody's retirement's in 401. There's much more reliance on there's a financialization, some people call it, of the economy. Can we handle a 5.6 economy? 5.6% on the 10-year or higher? Can the system handle that?
This is one of my favorite questions, Maggie. Can the system handle this is a great question, because I think you need to define system.
Mm,
Are we talking economic system? Are we talking market
the
system?
market system.
The economic system can handle it very much so. If you look at sort of one of the ways in which we so contributory to our resilient US economy thing, which we've maintained since the summer of 2022, contributory to that theme is the fact that we've been in this income driven business cycle. You can clearly observe this with private non-financial sector debt to GDP ratio has been declining the entire time, which means GDP is actually growing faster than credit growth, which is anomalous relative to history. Most of history, we've had credit growth outpace GDP growth because we've had these credit-driven business cycles. Well, this not recently. We've had this income-driven business cycle, and that's been contributory. That and the fact that we term out our debt here to the rates that we that are unprecedented relative to the rest of the world. We term out our debt here, so we have these really low debt service ratio of only 15%. Relative to historical means, peaks of 18 to 22%. And then we have most of the non-financial sector debt here is not on bank balance sheet. So it's not repricing with the policy rate to the same degree that it historically has. About 70% of our debt is coming from the capital markets. So answering the first part of the question is, can the economic system handle higher interest rates? Absolutely, yes. We've proven this for the past 2+ years with this resilient US economy thing. But can the market system handle higher interest rates is a very separate question, and one I would answer is that the answer is probably not. And the reason we say that is when we refresh our positioning model and we study the time series, the long-term time series in our positioning model that correspond to the medium to long-term outlook for asset markets in our risk management nomenclature, that's 3 to 12+ months. If we study those time series, most of them are currently breaching levels that have been hit, that they've kind of consistently shown at these major bull market peaks: August 87, July 1990, July 98, March 2000, October 07, April 2011, September 18, February 2020, and January 2022. The AI stock allocation survey is already breaching the median value as observed at those major bull market peaks. The AI bond allocation survey is almost breaching the median value that is observed at that major bull market peak. The AI cash allocation survey is breaching the median value to the downside that we've observed these major bull market peaks. S&P 500 realized volatility, which we use as a proxy for systematic fund exposure to the market, is nearing the level that we historically observed at these major bull market peaks. S&P 500 3-month implied volatility correlations, which we use as a proxy for market neutral hedge fund gross exposure, is breaching the level that we've historically observed these major bull market peaks, as are the S&P 500's price to next 12-month earnings ratio and investment grade credit spreads. So most of these indicators are breaching the median value that they've observed these major bull market peaks, and the ones that aren't are right on the heels. And so this is a positioning cycle that is incredibly asymmetric. People are very much betting on positive outcomes from the perspective of growth, inflation, policy, and liquidity. And what we're arguing is that based on the triple S's theme, the size, sequence, and scope of these fiscal and regulatory policy changes, as well as a potential hawkish shift in net financing policy, as well as a potential upside persistent trend higher in inflation that would be represent an upside surprise to consensus estimates and the Fed's estimates. I don't know, man. I think you could potentially have a crash in asset markets if we get all the bad stuff concentrated, first, or concentrated, to cluster it together in a way. I think there's a way in which we could spread it out and kind of deal with this stuff over time. But if we cluster the bad things together
Mm.
based on this asymmetry in the positioning cycle, this is how market crashes develop.
So very wise words. It's really important, I think, for everyone to take this opportunity at the beginning of the year, knowing we have all this uncertainty, to really do an inventory, like do a serious inventory of what your situation is, no matter how old you are, so you can at least be prepared and make sure you stay informed and up to date. Darius, we always appreciate you coming on and sharing your systems and your dashboard with us. It's a huge amount of data, but it's super important to kind of stay locked in that and not get carried away with the narratives and all the sort of crazy talk that's all over social media.
No, Maggie, I appreciate you saying that. And one final thing I'll say on all this is, we just talked about a lot of fundamental dynamics, growth, inflation, policy, liquidity, et cetera. A lot of these, nothing I said from that perspective has any bearing on how we think investors should be positioned. We manage, systematic overlays for our clients, KISS being the one for our retail investor clients, Dr. Mo being the one for our institutional investor clients, that send, very clear signals of, take risk on, risk off, take
Mhm.
your risk to this level, take your risk to that level, up and down, and so on and so forth. And so that to me is going to be a much more, it has been and will continue to be a much more powerful way to manage risk relative to these fundamental dynamics, which, by the way, we could be wrong on a lot of this fundamental stuff. But as long as we're respecting those market signals and the trend following elements of those signals, we'll do a great job of managing risk in what is a particularly uncertain year for investors.
Yeah, no, absolutely, absolutely. Appreciate everybody who's in the chat, and thank you so much. Thank you for helping us get to 10,000, and thanks for the the call out on that. Paul wants anyone who's not in the chat to feel welcome that they can come in the live chat, but if you don't, then feel free to leave a comment underneath, and we'll make sure we read them all, and we'll get those questions up and answered for you. Darius, thanks so much. Loved
Thank you,
hanging
guys.
out with you today. Appreciate it.
Can't wait to do it again. Looking forward to it. Appreciate you.
Awesome. Thanks so much, and thanks to all of you. As always, take care and good luck out there.